In this lecture example, we are going to be looking at section 24, which is the debtor's allowance. So let's start by reading the question. A Limited has a 31 December year end. A Limited sold a motor vehicle which is trading stock to Mr. X on a suspensive sale agreement. In terms of the agreement, the vehicle would only become Mr. X's property once he had paid 100% of the selling price, and this vehicle was sold on the 1st of January 20X5. The vehicle cost A Limited, so the A Limited, remember, is the seller, 350,000 rands excluding VAT, and the cash selling price of the vehicle is 500,000 rands plus 70,000 rands in VAT. Mr. X will repay the vehicle in 3 annual installments which are due on the 31st of December each year, so 20X5, 6 and 7. The installments are 249,647 rands per annum, and the interest charge is 15%. A Limited is a registered VAT vendor, and A Limited's financial manager compiled the following amortization table. Now, this is the same type of amortization table that you see in management accounting and financial accounting. I don't expect you shouldn't be asked to do it. I don't expect you to do it. For tax purposes, they will give it to you. Okay, but let's understand quickly, just talk about what is this amortization table. So the first thing is there's a part of this which is VAT. Now, you are paying that 70,000 rands, or this guy, Mr. X, is paying that 70,000 rands in VAT off in installments. From a VAT perspective, remember, this 70,000 rands will be accounted for as output tax on the earlier of delivery or payment, because this is an installment credit agreement. So we don't really care about that. What we care about is this capital amount here, which is excluding VAT. We care about that. And we care about the interest amount. Now the interest this is the interest, obviously, as we know with an amortization. You think about it, you put the total cost here is 570,000 rands, that's the selling price including VAT. But this person is paying 249,647 times 3. Right, so the person is paying 748,941. What's the difference between those two amounts? The selling price including VAT and the total amounts paid, it's interest. Now that interest, guys, is taxable as normal. It's normal interest. So check the 85,500, 60,878 and 32,563. There's the 85.5. There's the 60. There's the 32. Alright, so normal. If this is a natural person, in this case it's not, but then you'd also get your exemption. Alright guys, so now we can talk about section 24. So section 24 applies if 25% or more of the amount is receivable more than 12 months later. Now, just think about it. This person is paying it off over 3 annual installments. So at the end of the year, there will be 67% of it still outstanding, because it's 33.3, 33.3, 33.3 if you pay it off in 3 annual installments. Right, so first one will be done, so there's 66.6, 66.7, 67% left. Alright, so section 24 will apply. What does section 24 say? The amount that you sold it for, the 500,000 rands, must be included in full. There we go. This question doesn't show it, but you'll also get a deduction for the trading stock. Okay, my solution doesn't show it, but that's not the focus here, but you would get that deduction, obviously. Okay, then you can work out what the gross profit percentage is. The selling price was 500,000. All the amounts must be excluding VAT. The cost excluding VAT was 350,000. Gives us 150,000 rands gross profit. 150,000 divided by the selling price gives us a 30% gross profit percentage. That 30% gross profit percentage is what we are going to be using to calculate our section 24 allowance with. Section 24 says you apply that gross profit percentage. Well, this is how it works. Section 24 just says the commissioner will tell you what the allowance is, but how it works is you apply that percentage to whatever the balance is that's outstanding at the end of the year. So 356,012 times 30%. In the next tax year, there's 190,425 outstanding. So that is what you apply it with. And make sure you see the prior year amount is added back. Okay, and then in the final year, there's nothing outstanding, so section 24 will no longer be applicable. Okay, and there's the amount from the prior year added back. And that is how Section 24 works. It's very simple, guys. So basically what you need to know, the majority of it, is adding it back, applying the percentage, and remember to treat interest correctly. Obviously also, the VAT transaction, if they ask a VAT question, you need to know that. Make sure that you revise installment credit agreements in VAT if you can't remember them.